Hello, and welcome to this video on understanding a profit and loss. I've created this video for you to help you understand the terminology behind a P&L and also to give you an insight into your own numbers. But most importantly, I want to give you a sense of control over the financial side of your business. So what is a profit and loss? So there are a number of key monthly management reports, and the profit and loss is one of those. It basically shows you how your business is doing financially for 1 month and for the year to date. So it gives you a great idea if you're on track to make a profit for the year, which of course is something that most CEOs and MDs are really keen to find out. It can also help you to know if you can employ more people, or perhaps if you're employing too many people. And it can show you if your overhead costs are too high or too low. Basically, it will help you to really focus in and pinpoint areas in your business that you need to look at in order to keep your business on track and growing. Okay, so in front of you, what you can see is a profit and loss, and it's for a company called the Training Company Limited, looking at the month of August. The Training Company Limited is a company which turns over about $1 million, and this is based on the profit and loss of various marketing companies that I've worked with. So what I am going to do is I am going to work through the different sections of the profit and loss with you, and if your profit and loss, it looks slightly different to this, don't worry. Most of the key concepts will be the same. So what I would recommend is there is a downloadable PDF on the training page of my website. So if you go and download it, you can work through the numbers with me. Okay, so before we dive into the profit and loss, I want to talk you through two key concepts. The first thing is to say that the profit and loss is more than just a set of numbers. It's a really powerful comparison tool. So it gives you a comparison of your financial position based on the full year, and even shows you how you were doing last year. So when you compare 2 or more time periods, this really helps you to determine your profitability and your financial position. So for instance, if you had a really rubbish year last year and you were looking at your August numbers, you could say, okay, well, I know that last year was rubbish, but look how well we're doing this year. All right, so if you have a look at the slide in front of you, what you're going to see is you're going to see 2 main columns, one in the middle and one to the right. So the column in the middle shows us the information for August 2020. You can see we've got our actual numbers, the numbers for last year, and then the variance between the two. On the right, you can see the numbers for the year to date. You can also see the actual year to date, last year's year to date, and the variance. The second key concept that I want to talk you through basically says that all the income and all the costs that relate to the period that we're in need to stay in the period that we are in. So I'm going to explain this in a clearer way with 2 examples. If you raise a sales invoice in August, but it relates to September, to work being done in September, then your finance team will take that income and put it into September. In the same way, if your landlord bills you for your rent in August, and the rent is quarterly, so it's for August, September, and October, once again, your finance team will put that cost into August, September, and October. So in the income example, that relates to pre-billed or deferred income, and for the rent example, that relates to prepayments or deferred costs. Okay, so let's dive into our P&L. So we're first going to have a look at turnover, and turnover is basically all the sales in the month or the year to date. Turnover can also be known as revenue, income, or sales. What I would suggest is that the management team just decides on one thing and calls it that, just to keep it simple. What you can see in my example is that we have 2 line items in our revenue or turnover, and the first one is all the fees, all the stock income from stock. Then we have a line which is called other income. So basically, if you were a marketing company and you went to travel to a meeting, you had a hotel cost, you had some food, you maybe took a mock-up, that would be called a third-party cost. And most companies would charge this onto the client. So this would fall under the other income. Also, let's say you sublet your office. That rental income would also be shown as other income. So a little bit on analysing your turnover. So depending on what type of company or industry you are in, you'll expect to see a certain level of turnover. Perhaps you are a fee-based company and you have similar clients, so then you would look and see that 115,000 turnover and go, okay, well, most months I'm going to expect to see that. But let's say you are a hotel in Cornwall, you would expect to see high turnover in the summer and low turnover in the winter. What I would recommend you do is you really drill down into those numbers, see what sales invoices make up that 115,000, see what the mix of clients is, and by doing that analysis, it will give you a really good understanding of, do you need to go and find new clients, do you need to change the mix of clients, or maybe even the way you invoice those clients. Okay, moving on to the cost of sales. So this basically does what it says on the tin. This is the cost of creating the service or the product, and these costs include temporary staff, the third-party costs that I was talking about. Let's say you are a flower seller. This would be the cost of the flowers that you go and get at the market at 5 in the morning. And basically with the cost of sales, you want to try and keep these as low as possible, so that you've basically got money over to put into savings, to cover your overheads, and to reinvest into the business. Okay, your gross profit. So your gross profit is also known as your top line, and it is your turnover less your cost of sales. And as I said, you want to try and keep this as high as possible. Right. So I'm going to give you 3 ratios in my talk, and a ratio basically compares line item data from your financial statements to give you insights into your profitability, your liquidity, your operational efficiency, and it's a really powerful little tool. The first one I'm going to talk about is your gross profit margin. Now, this is your gross profit divided by your turnover times 100. And if you have a look at the slide in front of you, what you'll see is I've given you your gross profit margin for both your month and your year to date. Now, most of my clients like to have a look at the information for the year to date, because they have an idea of what they want to, what profit they are looking at for the year, and looking at the year to date will give them a feeling for where they are and what action steps they need to take. So if you have a look at my gross profit margin, you'll see it's sitting at 85%. Now, I'm really happy with this because this leaves me a lot of money over to do whatever I want with. Moving on to overheads. So the overheads are basically all the other costs involved in running your business. They include your staff costs, your property costs, your computer costs, staff welfare, staff training, new business costs, accounting fees. They also include a sundry income, which is called interest income, and also include something called depreciation, which is basically the cost of the wear and tear of your fixed assets. Now, a number of my clients have said to me, oh, this isn't a proper cost, but trust me, it is, and you need to account for it. So analysing your overheads is a really important way of figuring out if you can cut any costs. And what I would recommend is that each month you look at each of these costs and you just see if there are any areas that you can make any cost savings. Go back to your suppliers, ask your staff, see if you can get the best deal you can. So for instance, in the coronavirus times, a lot of people have given up their office costs, and this can save you up to 10 grand a month if you're a sort of medium-sized company. But also be aware that if you do cut your costs, let's say you cut your computer support costs, be aware that this opens you up to the risk of being hacked. And also, a lot of companies have a look at cutting their staff costs because this is one of the highest costs they have. But also be very aware that if you cut this cost, you really risk your staff getting knackered, doing bad, servicing your clients badly, and maybe losing clients. So just be very careful in what you do with your overheads. Right, my next ratio I'm going to take you through is called the SRS ratio, and it is my staff costs divided by my turnover times by 100. So in this example, I've used my payroll, pension and health insurance numbers, but I haven't included my temporary staff and my recruitment. Now you can include those, but just if you do, just make sure you're consistent and you include those. For me, what you can see is that my ratio is sitting at 49%. And for a service company, if this ratio is anything lower than 50%, you're really knackering your staff. And like I said, you risk losing your clients. If it's anything over 60%, your staff might be sitting around just twiddling their thumbs. So you really want it to be somewhere in between. In this example, I've got temporary staff costs of 6,000, so I don't feel too bad about this, but just to be aware that this is a very expensive way of bumping up your staff. Okay, going on to your net profit. So your net profit is also known as your bottom line, and you have a pre-tax net profit and an after-tax net profit. Corporation tax in the UK is sitting at 90% at the moment, but this might change after Corona. What we want to do is we really want to keep our net profit as high as possible. So the third ratio that we're going to have a look at is our net profit percentage, and this is basically our net profit after tax divided by our turnover times by 100. So what you can see in this example is my net profit percentage is sitting at 10%. Now, I'm not so happy about this because I don't have a lot of money left over for dividends if I want to give my staff bonuses. So I probably need to go back to my overheads and really analyse the numbers and see where I can cut costs. Okay, to summarise. So our P&L is a really powerful tool to help see if we're on track to make a profit for the year and for the month. It helps to show you potential periods of low turnover. It can help highlight areas that you can cut costs. And while, of course, the aim is always to make a profit, just be aware that if you cut one cost, you might increase another and you might add a new cost altogether. So it really is a balancing act. One thing you can do, if you have a budget or a forecast, you can simulate changes in your budget to see what's the effect is going to be on your profit and loss. And this can be a very useful thing for you to do. Okay, so that's it. Thank you so much for watching. I hope it's been useful for you. If you have a P&L that you need help understanding or you need a P&L setting up, please get in touch. I would love to support you. Thank you so much. Take care. Bye for now.